so excited because our guest today is Pamela Yellen, founder of Bank on Yourself. She's a financial investigator and author of the New York Times bestselling books, including The Bank on Yourself Revolution, Fire Your Banker, Bypass Wall Street, and Take Control of Your Own Financial Future. I love it. Pamela investigated more than 450 financial strategies seeking an alternative to the risk and volatility of stocks and other investments, which led her to a time-tested, predictable method of growing wealth now used by more than 500,000 Americans, including me, which I'll talk about more in a bit. But her last book is Rescue Your Retirement: 5 Wealth-Killing Traps of 401ks, IRAs, and Roth plans, and how to avoid them. And also joining us is Steve Holtz, the financial professional with advanced training on the Bank on Yourself strategy. And Steve also is a best-selling author and was instrumental in designing and helping me design and set up my own plans, which I have 2 Bank on Yourself policies and started researching this, I want to say back in 2012, 2013. Let's start with you, Pamela. Tell us a little bit more about yourself. I know I gave you kind of a long introduction, so let's just go straight into how do these policies work?
Okay, yeah. And I would like to give just a little bit of background, and that is what brought me What brought me to the Bank on Yourself concept was that my husband and I had been trying for quite some time to follow the conventional financial wisdom. Invest in the market, have a qualified plan, defer taxes, all of those things, and we did exactly what we were taught, and we just weren't having any success with it, and we never seemed to be able to get what the markets were getting, and so we decided, let's hire experts. And we ended up hiring 3 of the country's top and most expensive money managers to manage our portfolio and our profit sharing plan. And that was going back to not the most recent bull market that just ended, but the one before that. And during that bull market, all 3 of those high-priced money managers ended up losing us money during what at that time was the longest-running bull market in history. And we just figured, all right, that's it. So we started researching all kinds of different strategies and financial vehicles. I have been a consultant to financial advisors and insurance agents like Steve Holtz, who's on the call with us. And they were always bringing these ideas to me. And so I started researching them. I figured there had to be some gold in there somewhere. And after researching more than 450 different strategies, I found that most of them weren't even worth the paper they were printed on. But fortunately, it was scary. It was very scary. Most of them were actually dangerous to your wealth. But finally, one of my advisor clients said to me, Pamela, have you ever heard of this strategy? And I had not. And this strategy turned out to be something that is I call Bank on Yourself, and that I started researching in depth, and I have now researched it and used it personally to prove that it's everything that it's promised to be and then some for really 20, 30 years, because I was even doing some of it before I knew that I was doing it. And what it is, and this is where people tend to have a knee-jerk reaction. So I'm going to ask everybody who's listening or watching this to hold your knee-jerk reaction to what this is. It is a supercharged variation of an asset that has grown in value every single year for more than 160 years. Actually, it's closer to 200 years. It's never had a losing year, not during this current pandemic, not during the Great Recession, not during the Great Depression, not during the 1918-1919 Spanish flu pandemic. It has never had a losing year. And like I said, it's a supercharged variation of an asset, and that asset is dividend-paying whole life insurance. And the minute someone says whole life insurance, most people just go, "Oh my gosh, isn't that the life insurance policy that Susie Orman and Dave Ramsey and every other expert says you is just the worst place to put your money?" It's definitely not that type of policy. It has options or riders added to these policies that make your cash value, which is the money that you can access while you're alive, it makes your cash value grow significantly faster than it would if you bought a traditional whole life policy, the kind that Susie Orman and Dave Ramsey and everybody else love to hate. Those do grow much more slowly. And these riders that you add to them, it requires that the person, the advisor or financial professional who sets the policies up, has to be willing to take a big cut in commission. The commission cut is actually around 50 to 70%. And I mean that they're going to make that much less in commission because these riders are going to make your cash value grow much more quickly. So that's probably why a lot of people listening or watching this haven't heard about it. It's hard to find people like Steve Holtz who are willing to take that commission cut.
Yeah, and Steve, when we were kind of putting my policies together, I remember coming into your office, and I think I even had a breakdown crying session because I was like, I was already freelancing at the time. Wasn't really working for a business that gave me the opportunity to have a 401k. Had already read the book, but still was a little confused about how it works. And you were able to clarify, how we were able to set it up to where in the first, I think, 3 to 5 years, I put maybe double what I would put in for the rest of the years until retirement. How did you kind of set that up, and what strategies do you use when you work with your clients on how to even go about that?
Well, every policy that we design is individualized for the people that we're working with, Cassandra. So that was, that particular design came out of learning about what your situation was at that time, what you could afford, mm-hmm. and what you felt you could do beyond that period. And, you did follow the strategy. You were a very good disciple, a very good student. And as a matter of fact, what you ended up doing, and maybe I'm stealing your thunder here, was setting up a second policy not long after you had set up the first, even while you were putting in that extra money into that first policy that you had.
Yeah.
And those two policies, I was actually looking at where you stand prior to getting on this webinar with you, and you're doing quite well. And
Thank you.
Served you well.
Thank you. Yes, and the interest. Yeah, go ahead, Pamela.
I was gonna say, Steve, did the policies skip a beat with this market rout that we've had, and since the pandemic hit and since the shutdown, did they skip a beat?
Well, I can say with absolute certainty, Pamela, that Cassandra's policies have not skipped a beat, my policies have not skipped a beat, and your policies have not skipped a beat, because that never
In
happens.
fact, it never happens.
And furthermore, these are not you could actually take a loan out on your policy at any time. You will pay an interest fee, but the interest fee goes back. It kind of helps, mm-hmm. Keep the policy moving forward. It's almost like your own bank, right? Will you tell us a little bit more about that?
The way I talk about the policy loans, they're very interesting the way they work. Bank on Yourself professionals like Steve use companies that offer something called non-direct recognition policy loans. I know that's a mouthful, but basically what that means is that when the life insurance companies at the end of the year, they look at all of their expenses and their mortality costs and the death claims and so on, and they look at the income that they've received and the premiums and so on. And when there's a profit, which they've shown a profit every single year for forever, when there's a profit, rather than being like a company that is a stock owned by stockholders on Wall Street, the policy owners essentially own the company. And so if there's a profit, and like I said, there always is, there always has been so far, they pay a dividend to all of the policy owners. And those companies have paid a dividend every year as well. So when you have a policy that is dividend paying and has that non-direct recognition feature, when you take a policy loan, they continue to give you this, you're going to get a guaranteed, predictable annual increase in your cash value, no matter what. They're going to keep paying that to you. But if you have this non-direct policy loan feature, then they also will pay you the same dividend as though you had never borrowed a dime from the policy. So it's kind of like your money's kind of doing double duty for you. It's earning money in the policy, and then it's, whether you purchase something with it or you used it to take advantage of an opportunity, it just keeps growing. In fact,
or there's a pandemic and you need to borrow $5,000 from yourself.
Yes. Why don't you talk about how you recently used your own policies? Do you want to talk about that?
Sure. Yeah. I have a small production company, and I've been building out some projects for several years. One of which has been documenting women getting out of prison. My policy helped me through opening a home for women that were getting out of prison. It kind of kept me afloat through that process. And now that this whole thing is happening, I've been able to kind of go back to those projects, and there's new life that has been breathed into those projects. And it has enabled me to kind of take a beat. It's the whole situation. I wouldn't say it's just, one thing, but it really has allowed me to expand the business that I've always mapped out for myself. And so now I'm able to kind of focus on those projects. As I build those out, I'm not strapped for cash, and I could really grow into what I've always, what my plan has been is I'm actually able to do that now. And so I am planning, and I am creating systems that will be making a bigger return on what my typical business was. But this has enabled me to set that up properly and have the time and allowance to be able to do that, which has been really cool.
Isn't that wonderful? Because so many people right now, and since this pandemic hit and the shutdown hit, and people lost their jobs, their hours are cut back, they don't, their cash is king. Cash is king. Being able to get your hands on money without having to pledge your firstborn, qualify, fill out a nosy application, and then potentially, if you don't pay it back on their terms, you're going to have black marks on your credit report, repossession calls in the middle of the night, or people pulling your car away. Mm-hmm. When you take a policy loan, you don't have any of that. They only ask you two questions: how much do you want, and where do you want it sent?
Right.
And it's usually a two-page form. On the first page, you're telling them how much you want, as Pamela indicated, and then you're signing the second page. And then the money generally magically appears in your checking account within a matter of days.
Yeah, and what a lot of people might not know about me is I've been with my boyfriend for over 10 years. And at one point, my parents were like, hey, you don't have to wait to have a wedding. We'll throw you some cash. And I actually put that cash into my second policy because I was like, look, we know we want to be together. We don't have to, we will have a celebration at some point, but that was an unconventional thing that we did, that now I'm looking back on it going, so glad that I did that. And what people also might not know about these policies, which is actually really cool, is Walt Disney had policies like this. And this is when he started Disneyland, he was actually able to use these policies. Isn't that correct?
Yeah, no. When they were starting Disneyland up, they couldn't get any banker. The bankers thought that was a ridiculous idea, and so he took a policy loan. Again, no questions asked, other than how much do you want and where do you want it sent, and that helped. There probably wouldn't be a Disneyland if it wasn't for that. The same is true. A lot of people don't know this. McDonald's, Ray Kroc, used his dividend-paying whole life policy to help fund, a big project, the Ronald McDonald Project, and going back quite a ways. And if it wasn't for that, who knows? Would we have all those golden arches all around the country?
Yeah. Well, when you hear of people like that doing it, you are like, oh, well, if they did it and they got wealthy doing it, then it's kind of, and there are some analogies of how this works, because it can kind of sound like a gimmick or something, like you just put money in and you keep on putting it in and all of a sudden it just grows like magically. But some of the analogies are, like how trees are forested, like you plant them, and it takes a while for them to grow, but you keep planting them throughout all of that time. Is there another way of, I know I'm not really expressing.
No, you did great, Cassandra. That's a great analogy. And that really points out something that I like to make obvious to people. I don't like to mislead people. We are an immediate gratification culture. That is one of the reasons why most people have most of their retirement savings in the stock market. And when you have all of your retirement savings in the stock market, you'll never, ever be able to answer the question, what will your retirement account be worth on the day you want to tap into it? And that's really critical. That is part of the reason why there is so much financial insecurity, why so many people can't sleep at night. And this bank on yourself, even though we call this a high cash value, dividend paying whole life insurance, because you're going to have far more cash value than with a traditional whole life insurance policy, this is not a get rich quick scheme. It's not something you can put under your pillow and wake up rich tomorrow. If you want to do that, go buy a lottery ticket. So it's going to grow more slowly at the start, and it gets more efficient every single year you have it. In fact, it is actually guaranteed to grow by a larger dollar amount every single year. Yeah, what else can you invest in and know it's guaranteed to grow by a larger dollar amount?
Yeah, it's not gonna be like, oh, I hit the jackpot because I put my money into this, one thing, and now my money just jumped a crazy amount. But as it grows, it gains momentum. So over time, by the time you're at that 15th year or 20th year, plus when you're pulling it out as a loan, say you want to buy a car or something like that, you're paying the interest back into the policy and you don't get docked for it like a 401k. I think a lot of people right now, they're looking at their 401ks going like, gosh, I wish I could pull that money out without getting docked, right?
Well, yeah, you have penalty. And then I know if you're affected by COVID-19, there are some things you can do that you wouldn't normally be able to do. But and those are going to end. They're going to stop allowing you to do those things. But these qualified plans, 401ks, IRAs, Roth plans, 403bs and KIOs and simple plans and pension plans, they have more strings attached to them than Pinocchio when he was a real boy. I mean, there's limits on how much you can take out, when you can take it out. There's penalties and restrictions if you don't follow the rules. There's requirements to take a certain amount of money out and pay taxes on it. And speaking of taxes, let me ask you, Cassandra, what direction do you think taxes are going to go over the long term?
Up. I think that we can all agree on that.
You had to think a long time, but no, I'm kidding. No, everybody knows what direction. Trick question. Yeah. Well, if I'd asked that question a year or two ago, believe it or not, there were still people who said, "Oh, I think I'll retire at a lower tax bracket."
Right.
Anyone who says that now, wake up. Wake up. If you really believe the only way you're gonna retire in a lower tax bracket is if you're dead but broke. So
yeah, well,
so
also,
here's,
go ahead. Yeah, sorry.
Yeah. Well, I was gonna say that the life insurance, the cash, its taxation of these policies is similar to a Roth plan. You put in money that you've already paid taxes on while you know what your tax rate is. And then it grows tax deferred, and then you can take out both your growth and what you put into it if you do it in a certain way, and it's a pretty simple way. But if you do it in a certain way, you can do that with no taxes due on it. So you're not going to be hit by tax surprises. You're not going to be wondering, what's the next administration going to do to tax rates? How are they going to double the national debt in the next year? Well, they probably will. But you don't have to, that's not a concern. You're paying your taxes now. You know what they are. There's no tax surprises.
And also, something that sticks out to me as well, because when you hear insurance in general, you think, well, by the time you die, then it's just over, right? But I've been able to put Eric as one of the, in case something happens to me, he'll get that policy.
Beneficiary.
The beneficiary, and my parents the same. I know I'm going to outlive my parents because I have I'm very clear on my life path, but if something happened and I ended up opening one for a kid that I have, and that is going to be theirs. That'll be left for their kids, right?
Mm-hmm.
And not only that, Cassandra, excuse me, Pamela, when you're leaving a life insurance proceeds to somebody, as opposed to what happens with our IRA money and our 401k money, you are leaving an absolutely income tax-free benefit to them. And when we leave our 401k money or our IRA money, either to the next generation, we are leaving a nice tax problem, right? Because all of that money is going to be income taxable at much higher tax rates than we have today. So
and that brings up inflation. Inflation is clearly happens, and there's no time over the long period that we haven't gone through inflation. I think when my grandpa was a child, I don't know, was a thing of milk was probably like 5 cents, right? You can't get anything for 5 cents these days. So how does that kind of transcend through inflation?
Well,
I can handle that, or
yeah, I think I can.
Go ahead.
Based on the way that insurance companies invest their money, in order to keep their promises to their policyholders, they are buying high quality corporate bonds. And what they want from those bonds is the interest that those bonds pay. They don't worry about the value of the bonds in the short term, because they're going to wait for maturity and then they're going to get their principal back and they're going to buy more bonds. When we have, by definition, when we have inflation, interest rates are going up. In an environment where interest rates are going up, what do corporations have to do in order to attract money? They have to offer higher interest rates, right? So the insurance companies are buying bonds at higher interest rates, which leads to greater profits for them. And for the companies we use, that means greater dividends for our clients. And there may be a lag time. However, in periods of increasing interest rates, increasing inflation, we're going to see greater dividends, and we have a better chance of keeping pace with inflation because of that.
Great explanation, Steve. And historically, that's exactly what's happened.
Interesting. Is there anything that I'm not bringing up that you guys feel is like important to put out there, or how you've personally been able to use these to leverage your own wealth and your family?
I'd like to tell a quick story of my own, and then I would love to tell everyone how they can get in touch with Steve, because he's phenomenal. He's one of the top Bank on Yourself experts in the country. Awesome. And if they'd like to see, without any obligation, what it might look like before they even decide if they want to move forward with it, and what their bottom line numbers and results could be with a custom tailored program, Steve can help them. And Steve's been a friend of mine for years, and I can't recommend him highly enough. Obviously, you know, you've had a great experience with him as well. The story that I wanted to tell is that it's, you know, it's wonderful to have a chance to get your hands on cash when the you know what hits the fan, as it has, and many people found they didn't have money and they're sitting around waiting, you know, 4 or 6 weeks or more for their stimulus check or for their unemployment benefits to come through. So many of those things have fallen down, haven't worked the way they were supposed to work, and people are stressed out and they're desperate. But there's also opportunities that come up if you have access to cash, and you've taken advantage of some of that yourself, Cassandra. When my first book that became a New York Times bestseller came out, I had made the decision that I wanted to really up-level the company. I wanted to help make it a bestseller. I wanted to have a website and software and people that could handle all of that, because it was a pretty primitive setup before that. And this was during the Great Recession, 2008, 2009, and nobody could get money. Consumers couldn't, but neither could business owners and entrepreneurs. They couldn't get money. I was hearing stories from all of my business owner and entrepreneurial colleagues telling me about how they had been friends with their banker for 20 years, played golf with them every single week, had never ever missed a payment on their loan. And they said, I need some money. And the banker said, well, there isn't any to loan. You know, Mark Twain said that a banker is a fellow who lends you his umbrella when the sun is shining, but wants it back the minute it begins to rain. And so I thought, I penciled it all out, and I thought, how much capital do I ideally want to invest in my business? Because I knew if I invested in my business, it would make a profit, I would get a really good return on that money, and it would be growing in the policy like I never touched it. And I came up with the figure $500,000. Well, I'd been doing this for a while already. So I had to call 3 companies, not one, to get $500,000 because I didn't have enough in just one. And with it, by the end of the week, $500,000 was in my bank account. I turned around, invested it in the company, got at least a 10-fold return on my money. And meanwhile, all my business owner friends were broke, and some of their companies closed. They were out of business. So it's not just about being able to cover the emergencies and the things that life invariably throws at us, but it's also being able to take advantage of opportunities. And with COVID-19, I think we've all become more aware of our mortality. We're not immortal. It can happen to any of us, regardless of age or health. And this actually also does have that death benefit, which can take care of your family and your loved ones and help you fulfill the promises that you made to them.
Okay, last question for both of you. How many policies do you have?
Well, I'm going to go first because Pamela has a lot more. I have 6.
So you go first.
I have 6.
Wow. What about you, Pamela?
I have 22.
Wow. And that is just yours, or is that your family's as well as your kids?
Family. Well, we have one for each of our grandkids. We have a couple for business purposes. We have some, for different, and as our incomes grew and we realized what a great strategy it is, we opened up another one. By the way, the main regret that people have about Bank on Yourself is that they didn't start sooner and they didn't put more into their policy. Right. So Steve, why don't you tell them how they could get in touch with you?
Well, I sent my info to Cassandra.
Yeah, I'm going to overlay your emails or your websites, and we're going to get you guys in touch with the list that we are blasting this out to. We might even just put it up on YouTube as well. So We will have that information in the links below as well as on the screen. And I can't thank you guys enough for joining me today. I want everybody to know that this is not a commercial. This is a strategy that has worked for me, and I want to share it because it's very good information. I'm getting nothing out of this other than I get to share this with great information with you. And so I appreciate you joining in the conversation, and I really appreciate you guys being here today.
Thank you, Cassandra.
Thanks a lot.
It's been a pleasure.
Thank you so much.
It's been a lot of fun, actually. Thank you. Have a great day.
We'll do it again. Okay. Bye.